Compartamos, it's a Mexican microfinance institution, probably generated more controversy a couple of years ago than any microfinance institution I can ever remember. What happened is that a bunch of the shareholders of the institution sold a bunch of their shares in a public offering, and because of a combination of circumstances, they made a huge killing on the sale of the shares. Core issue that people are arguing about, well, there's really two core issues. One of them was Compartamos was charging very high interest rates to its customers, and lots of people think that the profits that Compartamos produced for its investors were gotten by exploiting customers and charging them ridiculous interest rates. And then the other thing that people argue about is that Compartamos received something like $6 million in support from donor agencies in its early years. And some people feel that that money made its way inappropriately into private pockets. The reason that microfinance institutions charge high interest rates is that tiny loans cost a lot more to make than big loans. I mean, that's just intuitive. If I have $1 million to lend and I can lend it in one single loan to one single borrower, that's not going to cost me nearly as much as taking that same $1 million and lending it out in 10,000 loans of $100 each to 10,000 different customers. So costs are higher for microfinance, and if you want the micro lender to be around next year and the year after that and to be able to expand, it's going to have to cover its costs by charging a higher interest rate. But the question is, how much higher? In Compartamos' case, their interest rate included enough to cover their costs and also enough to produce a profit of about 50% a year on the equity that its investors had invested in it. The question is pretty complicated. If you were talking about a purely privately owned company financed and owned by normal business people, well, then we're all pretty used to the notion that the first actor that comes into a market will charge as much as they can, and that eventually competition will come in and reduce the profit to levels that are more in the interests of consumers. But the Compartamos case was different in this sense that the majority owners of Compartamos were not private individual business people. The majority of the company was owned by a bunch of pro bono organizations. The Mexican not-for-profit that had originally started the operation owned a big chunk of the shares. Also, Acción International, which is a international not-for-profit that supports microfinance around the world, owned a large group of the shares. And finally, the International Finance Corporation, which is the private sector lending arm of the World Bank, which is a development agency, not a profit-making agency, owned a bunch of the shares. And between them, these parties controlled about 70% of the company and therefore had control over its policies, including its interest rate policies. And was it appropriate for these do-good agencies to stand still while interest rates that contained so much profit in them were being charged? For me, to answer that question, the first place you have to look is what were these profits being used for? And here I'll go back into a little bit of history. Compartamos started doing its lending when it was a not-for-profit organization. It was ownerless. All of the assets and net worth of that not-for-profit organization belonged to the public in a sense. They could not go to private pockets. They had to be used for the public benefit. During that period, Compartamos charged high interest rates, produced high profits in the NGO, but all of those profits were used to expand lending faster, to reach out to more poor customers. These guys were idealistic young Mexicans who started out with a very clear objective. They wanted to reach 1 million Mexican women as soon as possible. Not everyone would agree with me about that, but to me there is a good development rationale for charging more, but expanding with that in the expectation that eventually rates were going to come down. The problem occurred in 2000 when that operation was moved out of a not-for-profit organization that had no owners, and it was moved into a for-profit company. And they had to do that to get a license from the Mexican banking authority. And at that point, the company had some not-for-profit owners, but also 30% of the shares went to private individuals. Some of those were managers and people on the board of directors of the operation, and others were outside investors. Now, when the company makes large profits, a different issue arises because some part of those profits is going to go out into private pockets. Most of the profits have been retained in the company to fund faster growth, but eventually 30% of the profits of the company would reach private pockets by one means or another. And then there's a direct conflict of interest between the private owners and the Mexican borrowers of the organization. Higher interest rates charged to the borrowers means not only faster expansion, but it means more money eventually going out into private pockets. It's a lengthy discussion, much of which hinges on whether Compartamos had other ways that it could have funded its growth at that point. I think it did. And based on that, my own judgment is that that interest rate policy was hard to defend from a development perspective. Other people would argue that the high profits have promoted a lot of competition coming into the market, and that at the end of the day, Mexican microfinance will be better off for it. But this whole issue seemed to provoke so much ideological rage on both sides. I didn't feel that was very productive. I think it's really important to look at the details of what actually happened. And one of the problems is that the publicity that Compartamos got creates a lot of static for microfinance institutions in other countries. Politically, it will always be hard to explain to people why poor people are getting charged high interest rates. For politicians and for the general public who do not understand how much more it costs to make those small loans, and who do not understand how important it is for those institutions to be sustainable so they can be around providing services tomorrow, these interest rates shock the conscience. And there's always pressure to impose interest rate caps. And usually, if those caps are going to be imposed in a political process, they will be imposed at a level that's so low that there's just a bunch of tiny loans that you cannot make sustainably. Those interest rate caps tend to have the effect of squeezing people out of the lower end of the market.